For decades, it's been the quarterly grind. Every 3 months and another report card.
But the conversation is changing. We're talking about what might happen if quarterly financial reports move to semi-annual, and whether that could finally free management to focus on the long term.
Plus, we've got the argument for long-term value, the risk of softer disclosures, and what this all means for your board's oversight.
Welcome to the pre-read.
Just like the slides you get before a big meeting, the pre-read prepares you, CFOs, and other executives for the next big thing. It's the global podcast where finance, sustainability, audit, and risk teams come together in the C-suite.
If you're making decisions at scale or need to understand the leaders who are, you're in the right place. This is the pre-read, brought to you by Workiva.
I'm Steve Soder, accounting enthusiast and Diet Coke aficionado.
And I'm Melissa Zucker, sustainability nerd and equal opportunist caffeine addict.
Recently, the president floated doing away with quarterly financial reporting requirements for U.S.-listed public companies,
which has, of course, caused some disagreement throughout the business sector. Steve, you know a thing or two about accounting and disclosure. How big of a deal would this be?
It'd be a really big deal, Alyssa. We started quarterly disclosures back in the 1970s, and there were a few things since the 1970s that we also moved on from, like 8-track tapes and rotary phones. The thing is, the market demanded this information, and investors wanted it in order to help improve their analysis, to reduce risk, and I think companies were happy to provide it. So this would be a pretty significant change to move back to that era. One thing to keep in mind, though, that I think is important is that back in those days, financial reports weren't nearly as long as they are today. We're talking about dozens of pages rather than hundreds of pages. And I think that's context that's missing from this discussion.
Well, I'm glad you've brought it up. I'm also glad you've brought up the rotary phone, because I don't know about all of our listeners, but, I think that's something I too would like to bring back from the yesteryears. But, something that actually was pretty fascinating to me, there was a recent Wall Street Journal poll on this that actually showed a divide between CEOs and CFOs on where they fall on this topic. They had 65% of CEO respondents that favored a switch to the semi-annual reporting, but the majority of the CFO respondents would rather continue the quarterly earnings reportings for maximum investor transparency.
Yeah, and honestly, Alyssa, to me, that's not a big surprise. I think in part because CFOs do see this process as pretty burdensome, time-intensive, and perhaps taking away from attention that they could be placing on other things. CFOs recognize that this process provides rigor. It provides, I think, a kind of recurring cadence that helps us be thinking about the business and be thinking about these disclosures. And CFOs also recognize that this information is needed out in the market. CFOs have a lot of responsibilities, and one of the things that generally falls within their purview is their coordination with analysts and investors. Well, I've never met an analyst or an investor who wanted less information. They only want more. And I think CFOs understand that if, quarterly financial reporting moves to semi-annual, they're still going to have some kind of dialogue with investors on the off quarters. And I think from a reputation and risk standpoint, they understand that this current process of 10Qs, though it may be cumbersome and may take up a little bit of time, it's actually quite a bit less risky and helps them avoid perhaps some, embarrassing missteps.
Yeah, I admit I've never sat in the accountant's chair, but it does bring up to me the idea of just slowing down to speed up, right? The actual value in what this information and these disclosures actually represent in conveying them and communicating them out to market in terms of building that confidence and providing that transparency. So makes sense to me.
Absolutely.
We sat down with Jonathan Johnson, the former chairman and CEO of Overstock.com, who also sits on other boards, and asked for his reactions to these possible changes. Steve, what stood out to you in that conversation?
Well, I think the first thing is the discussion we had about semi-annual reporting and long-term value. Moving to semi-annual reporting could legitimately help management teams stay focused on building long-term value, although I'm not sure that's going to play out in every single case. And the second would be the impact on newer or smaller companies. We've talked about it already. The onerous and expensive nature of current SEC reporting requirements may be discouraging for some companies to go public. So perhaps a softer touch for this problem would be potential accommodations like semi-annual reporting for newly public companies or smaller companies. What stood out to you, Alyssa?
Yeah, it was actually that point you mentioned earlier about still maintaining a more regular dialogue with your investors in the capital markets. But it was really that idea on continued internal rigor and board oversight, right? Even if the SEC reporting does become semi-annual, the good companies or the real leaders are going to continue with their normal reporting cadences, especially the internal ones as well, that you actually need to run the business with more informed information and decision making.
Yeah, 100%. I think there's no scenario at all where companies stop those internal processes. We're literally just talking about external stuff here, and I think it's important to make that distinction. On that note, we do have someone who is very familiar with that distinction and the process. So now let's get to our conversation with Jonathan Johnson. We're talking about all of the dialogue here about the potential change for U.S. public companies to potentially move from quarterly to semi-annual reporting, or at least having the option to do so. One of the initial things that gets talked about, or the rationale behind it, and there are several, but the one I want to start with is this thinking about quarterly reporting drives more short-term thinking, and this potential change might allow management to think more on the long term. As former chairman and CEO, and you've had other roles, including in finance, what's your take on that?
Well, look, I think good management teams are always thinking about long-term enterprise value, long-term shareholder value. So I think good management teams will continue to think about that. That said, with a quarterly cadence, there's a report card that comes out every 3 months. And, we all know that markets react to those report cards. And I think as much as management teams try to focus on long-term maximization of enterprise and shareholder value, sometimes the quarterly earnings have an impact on what they think about. So I do think that going to semi-annual will help management teams stay focused on long-term enterprise value. So I do think that's a legitimate and good rationale.
I think it's fairly likely that companies, even if given the option to report semi-annually, may still choose to do some form of reporting quarterly, whether that's similar to an earnings press release without the accompanying full Form 10-Q or something in between. If what you're saying is correct, could that still potentially drive that short-term thinking if the investor demands would be such that companies felt like they needed to produce something quarterly anyway?
It could. I think it means less of a change. I don't think it means no change, because I do think the full disclosure would be semi-annual. It'll be very interesting to see what the norm becomes in the U.S. if this rule is adopted. And I don't think there'll be a single norm. I think the norms may be by industry or by company size or by IPO date. Some new companies that, come out and become public may say, we're going to follow the rules as the rules are today and just be semi-annual. So, and I think it will be partly shareholder driven. I don't think it means that companies will be talking to shareholders less. It may mean that they actually are able to do a shareholder event, whether it's an investors conference or meetings with management, more frequently, because they're not focused on getting prepared for the quarterly earnings call and everything that entails, which is usually a lot. It's a lot of work to do those. So it may free up some time that can be spent on a myriad of things, including operations, but also shareholder communications.
Well, let's talk about that work as well. And no surprise, you and I used to work together along with many other people in that quarterly process. So we're both certainly familiar with it. One of the things that I always felt like the benefits is that it gave us an opportunity to sync kind of across the organization, sort of from top to bottom. Certainly there's some risk in that type of disclosure, which then required us to, really have things kind of nailed down. Therefore, in the absence of all of those kind of extra things, maybe there could be additional risks to, a non-Form 10Q type of quarterly reporting. I mean, would that make you feel a little less comfortable potentially?
Well, the first part of that question was I more comfortable because we were doing it every 3 months? Hard to answer that question because it's comparative to, what we weren't doing to what we were doing. I always felt comfortable signing 10Qs and 10Ks because I knew our team was on top of things. I don't think doing it semi-annually would make me less comfortable because I would have the same expectation of and confidence in the teams that were putting that together. And if we chose to do some kind of maybe softer disclosure on the off quarters, like a press release, I would certainly want those to be as buttoned up and as crisp as the press releases are at the quarter. So I don't think it would change my confidence that we were getting things right. And, frankly, I don't think it would change my confidence that I had a good view of the business, because even in a quarterly cycle, there's every month-end close. There's, internal meetings that are saying, how did we do in January and February, even if we were on a calendar fiscal year, and March was when the quarter ended. We weren't looking at it just once in a while. Books were closed every month, and key KPIs were looked at weekly, if not daily.
And I'm so glad you brought that up, because in the dialogue that I've been hearing, there does seem to be this incorrect perception that, well, if we don't look at it every quarter, well, then that means we're only going to look at it every 6 months. And the reality is, again, on a monthly, weekly, in some cases daily basis, these things are going to be looked at. And candidly, the SEC reporting aspect of it is really downstream and I think secondary to the information being generated to run the business as often and with whatever frequency is required. So I think we're both definitely in line in that regard.
Well, and it's interesting. We talk about SEC reporting and its GAAP compliance. A lot of times the metrics you're looking at aren't necessarily GAAP metrics. They're metrics that are more germane to running the business. Those will all be squared up and reported on a GAAP basis for SEC filings. I think that will happen whether we report quarterly or semi-annually. But I don't think that this means businesses don't get looked at as carefully by management teams. Not at all.
Jonathan, do you think that one of the reasons why we're having this discussion is because of how lengthy even 10Qs have gotten? If memory serves, I think the first Form 10Qs, which would have been in the 70s and 80s, 5 pages, 10 pages, and now we're talking about, 80, 90, or 100. Would we even be having this discussion if those disclosures hadn't gotten as lengthy as they were, do you think?
Probably not. Probably not. I mean, I do think the amount of work that's required to be an SEC reporting company has become more onerous over time. There's no question. You mentioned the length of the filings, also the items that need to be in the filing. Some of that extra burden is good. There's been cases of fraud and crisis, since the 70s or 80s or whatever time we want to look back to. So it's not all bad, but it is onerous and it does take a lot of time.
Because it is a ton of work and it's expensive. And you have people like myself who, you're thinking about that all day, every day. Certainly that does come as an opportunity cost to the business, if nothing else.
Well, and I think about companies that are trying to get ready to go public, to do an IPO. And, that number is down. There are less public companies today than there were before. And there are probably a lot of reasons for that. But one of it is, the onerous reporting requirements and the work to get ready to be public, the cost of them being public. I think these are discouraging companies that historically have grown to a size that historically would have been, oh, it's time to go public. They're pausing and thinking, maybe not yet.
Half of accounting and finance professionals say AI helps them quickly consume data and tackle time-consuming tasks, according to new research from Workiva. Don't get left behind. AI isn't just for tech demos. Today, it can draft earnings narratives, flag risks, benchmark ESG disclosures, and even prep your next board meeting, if you know where to look. Start with 9 ways the Office of the CFO should use AI right now at workiva.com/PR-CFOAI. See where AI is already working and how to make it work for you. That's workiva.com/PR-CFOAI.
You currently sit on other boards. You've been a board member for a long time, several different organizations. The oversight, the risk monitoring, the accountability, quarterly board meetings, I think, are kind of driven, at least in part, by this current quarterly SEC reporting process. Do you sense that there could be any risk or fundamental changes in how a board perceives risk and accountability if such a change were to be adopted by the SEC?
Probably not. I don't think so. I mean, I think boards understand their duties to shareholders. Management, when the board CEO/management relationship is strong, view that as a good time to check in, get ideas. It's not just reporting and going to the principal's office. It's more collaborative and drawing on the wisdom of a board. So I would think that boards would continue the same cadence they have today, just because management would want to report back and ask questions, and boards will still want to know what's going on. It's not uncommon for boards to have interquarter check-ins, and so I think it would be, even more common to have semi-annual check-ins if we were just doing SEC reporting semi-annually. I do think the quarterly check of how the company is doing, something management likes to do, it's something the board likes to do, and so I think it will keep happening.
The executive perspective on this has been really interesting. Admittedly, I've kind of spent my career in the weeds and still tend to think that way. So anything else that you think CEOs, CFOs, and other executives ought to be thinking? Is this maybe an opportunity for them to revisit some of these processes, or is this more of a wait and see moment?
Well, first I have to say, Steve, when you and I worked together, I loved it that you were in the weeds. It made me sleep easier at night knowing that you and others like you were making sure things ticked and tied and there weren't loose ends that could create problems. So I don't think senior management will view the importance of the finance department, the importance of an SEC reporting department any less just because that major SEC filing interaction happens twice a year instead of 4 times a year. I would hope that people that have been in my chair would think, yes, we're going to keep doing all the same kind of things to run our business so that it ticks and ties and runs well. Second, I really like this idea of semi-annual reporting. And it happens in other countries. It happens in Europe. I think it happens in Australia. It's not an pulled out of the wind idea. It's something that works elsewhere. And in those other places, shareholders are still getting ample information, in part because companies are providing it on an interim or, in between basis. And so, if it helps the company management team run the business better, I would think shareholders would like that, because ultimately running the business better is what creates more value for the business. It's not reporting more frequently.
Well, Jonathan Johnson, appreciate you joining us and appreciate the insights. There will certainly be a lot more to talk about, I think, in the months to come.
Thank you to our guest, Jonathan Johnson. And thank you for listening.
This has been the pre-read brought to you by Workiva, the world's only unified platform for financial reporting, sustainability, audit, and risk.
We've got more insights and hot takes coming your way, so be sure to follow or subscribe on YouTube, Apple, Spotify, or wherever you get your edge.
And if you like the show, please leave a review, send it to someone you love, or just shout it out on your next team call.
We'll be back next week. Until then, go lead it like you mean it.
I'm Steve Soder, and that's Alyssa Zucker. Our lead producer is Mike Gravano, with additional production support from Joseph Machinsky and Drew Hayes.
Claire Allison is our graphic designer. Transcripts are created and edited by Courtney Kimsey. Thanks to our digital and social team, Mike Berg, Katie Carr, and Michael Karnowski.